This happens 12 to 18 months before the currency collapse. It is the earliest signal. The recognition that the issuing government has overborrowed and the currency is going to be devalued to reduce the debt burden. This is when the smart money exits sovereign bonds. In 1971, the United States was running the Bretton Woods system. Under this system, established in 1944, the US dollar was pegged to gold at $35 per ounce. Other currencies were pegged to the dollar. The entire global monetary system depended on the promise that dollars could be converted to gold, but the United States had a problem. The Vietnam War and the Great Society programs were costing enormous amounts of money. The federal government was running deficits. To finance these deficits, the US was effectively printing dollars. But under Bretton Woods, every dollar was supposed to be backed by gold in Fort Knox. By the late 1960s, the number of dollars in circulation far exceeded the gold backing them. Foreign governments, particularly France and Germany, began to notice. In 1965, French President Charles de Gaulle held a press conference. He stated explicitly that the US was abusing its privilege as the reserve currency issuer. He said that France would no longer accept dollars. France wanted gold, and de Gaulle began executing Move 1. From 1965 to 1971, France converted $3.5 billion in US Treasury holdings into physical gold. They demanded gold from the US Treasury and shipped it to Paris. Germany did the same, converting over $2 billion in treasuries into gold. This was the bond exit. France and Germany understood that the dollar was over-leveraged. The US did not have enough gold to back the dollars in circulation. The system was going to break. So they exited dollar-denominated sovereign bonds and converted to gold before the collapse. By 1971, US gold reserves had fallen from over 20,000 tons in 1950 to under 8,000 tons. On August 15, 1971, President Richard Nixon was forced to close the gold window. He announced that the US would no longer convert dollars to gold. The Bretton Woods system collapsed. The dollar was immediately devalued. Against gold, the dollar fell from $35 per ounce to $42 per ounce by December 1971, an immediate 20% devaluation. By 1980, gold had risen to $850 per ounce, meaning the dollar had lost over 95% of its value relative to gold over 9 years. France and Germany, having executed Move 1 and exited dollar bonds for gold, preserved their purchasing power. Nations that stayed in dollar bonds, that trusted the system, lost 20% of their reserves overnight and 95% over the decade. Fast forward to 1985. The US dollar had become massively overvalued through the early 1980s. High interest rates under Federal Reserve. Chairman Paul Volcker had attracted enormous capital inflows. The dollar was strong, too strong. US exporters could not compete. The trade deficit was exploding. The Reagan administration needed to devalue the dollar. In September 1985, the finance ministers of the G5 nations, the United States, Japan, Germany, France, and the United Kingdom, met at the Plaza Hotel in New York. They signed the Plaza Accord, an agreement to deliberately devalue the US dollar against the Japanese yen and the German Deutsche Mark. But this was not a surprise to everyone. George Soros, running the Quantum Fund, saw it coming. Throughout 1984 and early 1985, Soros analyzed the unsustainable trade imbalances. He concluded that the dollar had to fall, and he understood that governments were going to coordinate to make it happen. Soros executed Move 1. He began exiting long dollar positions and building short positions. He sold US Treasury bonds. He went heavily short the dollar against the yen and the Deutsche Mark. When the Plaza Accord was announced in September 1985, the dollar began a controlled collapse. Over the next 3 years, the dollar fell 50% against the yen and the Deutsche Mark. Soros, having executed Move 1 and exited dollar bonds before the devaluation, made hundreds of millions of dollars. Investors who stayed in dollar bonds watched as their holdings lost half their value relative to rising currencies. In 1997, the pattern repeated in Asia. Thailand, Malaysia, Indonesia, and South Korea had been running massive current account deficits. They had borrowed heavily in US dollars to finance infrastructure and real estate booms, but their currencies were pegged to the dollar. This created a deadly trap. When the US dollar strengthened in 1996 and 1997, their exports became uncompetitive. Their trade deficits widened, and they did not have the foreign currency reserves to defend their pegs. George Soros and a group of global macro hedge funds, including Julian Robertson's Tiger Fund and Stanley Druckenmiller's Duquesne Capital, saw the setup. In early 1997, they began executing Move 1 against the Thai baht. They borrowed billions of baht, converted those baht into dollars, and sold the baht short. They were